So the new year usually brings challenges regarding retirement plans, and 2022 is no different. That's especially true when it comes to required minimum distributions. I've heard Brian say that a million times. He refers to them as RMDs. The IRS has put into effect new life expectancy tables for calculating the payments beginning at age 72. Why is this good news for account holders, Brian?
Well, it means you won't be forced to take out as much. So it's going to be slightly lower RMDs, so don't get too excited. But the new tables will be used by anyone who's taken RMD, even those who inherited an account a long time ago, right? Or those who are beyond the RMD required beginning date. So I think one exception in this article that's on IRAhelp.com, it's Lott, it's the one that wrote it, but is that if you've reached 72 in 2021, which would have been last year, and decided to delay the RMD into 2022, so basically if you have that exception, those individuals need to use the old tables to calculate the delayed 2021 RMD, even though they can take it in 2022. If you're not confused, you should be.
Yeah.
So, but the idea is Ed Slott is a expert in IRAs. I mean, literally, I think he's written, a dozen books.
Yeah, you've had him on the show a lot before.
Yeah, and so the concept with Ed, he's very focused on what we talk about is not necessarily what's in your IRA. It's what it's going to cost you to pay in taxes and retirement. And a lot of folks don't understand this is when you have other assets, that's the issue, right? So we had someone come in, they had $2 million in an IRA, and he's like, well, Brian, you're talking about RMDs, but I don't really need that. I thought I was going to need to use it for income, but my mom and dad just passed away, and I got another $2 million now.
Inheritance, yeah.
And this is a good problem to have.
Sure.
But $2 million in a taxable account too, meaning it's not in an IRA, it's not a Roth, right? It came from a variety of sources, real estate and whatever. But the point is that they didn't
whatever the estate,
right?
Yeah.
Exactly, but it was tax free to them. So they literally have to invest it in what? It's very limited what they could. They're like, we know my parents, they made good money in real estate, but we're too old for that crap. That's exactly what they said.
Yeah.
They're like, I don't want to deal with it.
It's a lot of work.
It is. I mean, at this point, they're aged, they're in their late 60s, and they're like, Brian, I don't really want that lifestyle anymore. The calls in the middle of the night about the water heater, the roof's leaking.
Yeah, pipe burst.
Yeah, whatever, right? We did that. But going forward, I'm like, what do we do now? We got all this money, and they're like, and then so we looked at it and we said, you need a comprehensive financial plan. And the idea is that, okay, so your RMD is going to be a little less with this new regulation, but it's still going to kill you the most. And RMDs are like the death to people that have other good sources of income and other good assets, but they just don't have they don't understand because most of the people are not doing planning like this. They're not talking about, well, we could do qualified charitable distribution, or we could do charitable lead trust or charitable remainder trust. There's all kinds of things you could do to help offset the tax, convert more IRA to Roth so you get more tax-free income. And that's not because you got a better rate of return. It doesn't matter, your investments or our investments or index funds or ETFs, Bitcoin, whatever you want to be invested in. It's literally just math because you're sitting there saying, I have to take out the distribution. We just had a client take out a $300,000 distribution and they didn't need it. So, because they did no planning. They were Charles Schwab. They called him their advisor. I'm like, don't call him an advisor. You had a broker. There's a big difference. They sold you some stocks, but they never gave you any advice because you had those assets for a long period of time with them for 30 years. And they didn't want to leave them. The kids who were our clients actually had to talk them into coming to us. And it took them years. They're like, oh, you need to go see Brian in Integrity. You need to go there. And finally, but by then it was like too late. What am I going to do? Right. And so you look at this and you go, could they have saved hundreds of thousands of dollars if they would have had a plan to start shifting and pay? Yeah, there's a little bit of pain, but you got to pay the debt down. You got to pay the debt down, and you got to understand the rules. And they're very confusing. I mean, RMDs and life expectancy tables and, QCDs, all this stuff. Yeah, it is. You can either become an expert on it and study it for years and years and years, right? Or you can pay someone else to do it. Those are your two options, really.
Brian mentioned a broker. It really is more than just buying stocks. You need the plan, the financial plan. It's a complimentary blueprint plan for you if you've saved at least $1 million or more towards your retirement, or $5 million or more. qualifies you for the private wealth division. That's also complimentary. If you call the number now, 866-2-PLAN-4, 866-TO-PLAN, and the number 4.